This is the Investor Connect podcast program. I'm Hall T. Martin. I'm the host of this show in which we interview angel investors, venture capital, family offices, private equity, and many other investors for early stage and growth companies. I hope you enjoy this episode. Interested in learning more about investing in startups, launching a new startup and need to raise funding? The Startup Funding Espresso is a daily podcast in a short, concise format delivered to your inbox every day, Monday through Friday. In the time it takes to drink an espresso, you can learn about startup funding. To subscribe, go to investorconnect.org and put your email into the pop-up box. Well, hello, this is Hall Martin with Investor Connect. Today we're here with Bharat Kanodia, founder and chief appraiser of Veristrat. Veristrat is a professional services company headquartered in Pleasanton, California. They provide various valuation and advisory services. Veristrat provides services to value various tangible, intangible, and financial assets for the purpose of financial and tax reporting purposes, fairness opinions, purchase price allocations, goodwill impairment, litigation and dispute resolution, and more. Bharat, thank you for joining us.
Well, that sounds like a mouthful when I hear it. Thanks for having me, Hall.
Well, great. So tell us about your background. What did you do before valuations?
I've always been in valuations. That was the first job I got out of college, except, I did all different kinds of valuations. I started doing industrial assets, and then I did real estate, and then I did financial assets. And in between those, I have done some most unique or interesting assets in the world. So I've been around the block in valuation a few times.
Well, great. So how do you help startup and growth companies with valuations?
Startup and growth companies are my favorite because they need a valuation every 3 to 6 months. They're always raising capital. They're either in the middle of raising capital, or they want to raise capital, or they just have raised capital and now they're looking to distribute equity to their employees. So they're the kind of clients that keep on giving.
Well, that's great. And so what's the challenge for doing valuations for startup and growth companies?
Well, when you're working with a startup, the first thing you always see is a hockey stick projection, right?
Yeah.
They're going to go from a zero to $1 billion in 6 months, right? And God bless them. If they didn't think that, they probably wouldn't be in that ecosystem. But it is my job to sort of do a gut check and see, hey, can they get there? Does the market sustain it? Do they have the operations to do it? So the worst thing about valuing a startup is because I have to tell them that no, their company is not worth $1 billion just yet. And most founders don't want to accept that.
And so how does a startup prepare for that challenge of finding the right number?
The right number really starts with the investment. So the first time a startup gets the investment, that's really the starting point. And there's really not much rocket science to it. Most people think that, startup valuations is too much involved. But no, the first time a startup gets a valuation is the most rudimentary way. So you ask them, hey, how much are you looking to raise? So say if they're looking to raise $1 million, you take $1 million divided by 10%, and then you take $1 million and divide it by 33%. So the value of the startup is anywhere between 3.3 and 10 million. And then it's the negotiation between the investor and the founders that where or how the cookie would crumble, and how much will they accept or are willing to give up for $1 million of raise.
And so who should the startup recruit to help them with that, finding that right position on that curve you mentioned?
That is really between them and the founder. That is between the founders and the investors. Smart investors also know that they shouldn't take more than 25 to 33%. 33% of this at the high end, because if they do that, they are shooting themselves in the foot, and it'll be difficult for them to raise future capital. And they almost would never accept less than 10%, because then it's like, okay, who cares? Right? This has to be worth their while. It has to keep things interesting for them too. So it's generally between 10 and 25%.
Great. And then if you talk about growth stage companies, those that are past the startup phase, but now on the growth curve upwards, Series A, B, C, and so forth, what does a company need to do to keep the valuation going up there?
At every inflection point, Hall, investors want to see the valuation at least double. So if at seed or angel round the valuation will say $1 million, at the next round they want to see at least 2 million, if not more, because unless they're doubling the valuation at each raise or each inflection point, the investors aren't really able to show unrealized gain to their LPs, and which makes them look bad.
Great. And so, where do you see most companies underinvest in this process? What should they be investing in to grow their business in order to achieve that doubling of the valuation? Where should the companies be focusing on to actually merit that doubling of valuation?
At the end of the day, it's all about customer acquisition. Now, you call it customer, or you call it user, or you call it, whatever you want to call it. It is acquiring more and more people to your story or to your platform or to your product, what have you. And that is really the crux of it. If you can convince more and more people to use your product or services, the better you are.
And do you ever see companies that overinvest in parts of the business that don't turn out to have that valuation multiple for you?
Oh, that's really the slippery slope. So many times, in founders, they are lucky enough to get two term sheets. One is say 50 million, and one is say 100 million in valuation. And the rookie mistake is to obviously go for the 100 million. But as I said, at every inflection point, they have to double the valuation. So if they took 50 million, the next inflection point is at least 100. If they took 100 million, next inflection point is at least 200. So they have to be careful. Sometimes taking more money can be detrimental to health.
And so what happens when the startup gets to that next fundraise, but they may be a little bit short on the metrics for the valuation that they want? Who takes the haircut and by how much? Does the investor take it? Does the startup take it? Do they split it 50-50? What happens when you know you have to raise that next round, but you're really not quite there and the valuation is going to be a little bit less?
Great question. That happens all the time. And they may not get a lower valuation, right? So it is to the founder's benefit as much as it's to the investor's benefit to ensure the valuation keeps doubling at least, or if not tripling, at each inflection point. But what they might do is kick in more terms and conditions under the surface. They might ask for more preference, or they might ask for a higher dividend rate, or they might ask for a 2x cap or something, or a anti-dilution round or something, which wouldn't really show up in the media. Because what you hear in the media, oh, they raised 10 million at $100 million valuation, that's really just the tip of the iceberg. The terms and conditions that are baked into the term sheet are far different. What you hear in the media is just post-money calculation.
So there are many valuation methods out there. What are the top three you use most often for startup and growth companies?
The three traditional methods of valuation, the income approach, the market approach, and the cost approach, those are not much helpful when it comes to startup valuations. Because in a income approach, you're trying to value the profitability of the cash flow. They have none.
Mhm.
In a market approach, well, there aren't too many competitors, or the market is probably being created as they go along, or they don't have any profit. So the only metric they have left is revenue, if they have revenue. And the third method is cost approach, which is really not used in um, valuing companies much anyway. So the real method of valuation is really a startup specific method, which one is based on the last transaction. That, okay, You received a valuation of 10 million in the last transaction, and it has been a year since your last raise. How has the company done between then and now? Right, that's one benchmark. Or the second way of doing it is something called, it's a bit of a mouthful, it's called PWORM, probability weighted expected returns method, where you're looking at 4, 5, maybe 10 different scenarios of what the potential exit would be like for the company, and trying to present value that exit today.
Cool. And so how do you choose the right valuation method among those three?
It depends on the company. It depends on the facts and circumstances. So if they recently raised a round, well, that's the valuation. Somebody just cut them a check for that number. So that's the valuation. If they raised a round, say 2 years ago, and the company has changed dramatically, and now they're getting closer to an exit. So now the valuation that we should be looking at is what somebody might pay if they were to buy that company. So it really depends on the stage and the life cycle of where the startup is. These are great questions, Hall.
Cool. We deal with valuations all the time, and it's a bit of a challenge because there's different methods. And I find what most entrepreneurs do is they go through 5 or 6 different models, and whatever gives them the best number, well, that's the right one. And then the investor on the other side of the table is doing the same thing, and they're the one that gives them the best ownership. Well, then that's the right one. And so I always tell people it's really not a formula; it's a negotiation, because everybody's bringing their formula to the table, but the winner is the one that negotiates. And so let's talk about that for a moment. How do you negotiate these valuations when you have opposing models on the table?
You don't negotiate. You tell a story. The investor is telling their story. The founder is telling her story, and it's a dance. They meet somewhere in the middle. You start to negotiate. It's kind of like negotiating with your future, father-in-law. That's not a good sign, right? I mean, an investor is going to be working with you for a long time, hopefully, right? That person is going to be part of your board. That person is going to be part of your work family. You want to treat them nicely. So you got to listen to their story. You got to listen to what they're saying, what their logic is. Look, they want you to be successful. The guy's cutting you a check. I mean, it's to his detriment to not have you succeed. He wants you to succeed. Listen, hear him out. And then hope that he would hear you.
Cool. So what do most people get wrong about valuations? When you work with both the startup and the investor, what's the most common mistake people have about it?
The most common mistake is people think there is a right answer. There is no right answer. It's always a range. But we're all taught and grown up in society to find that right number. 4 plus 4 is 8. Always find that right number. Well, it doesn't work like that in valuations.
And so what's the best way to approach valuations? You talk about telling a story and listening and so forth, but how do you advise people to approach this thing when it's a range and not a number?
Accept that it's a range, right? So that's why I say that it's less about negotiating. It's more about storytelling and listening to the other side of the story. It's not necessary. So if you have 2 term sheet, one says 50 million and one says 100 million, it is not necessary that the $100 million term sheet is better for you long term. You got to look. You got to look under the hood. You got to see who the investor is, who that GP is. Is he going to help you when shit hits the fan, right? Because look, you're running a startup. Things are going to go awry, right? You want to work with people who are not going to call you and bitch and moan at you. You want to work with people who are going to say, "Hey, I heard what happened. What can I do to help?" These are the people you want to go to battle with.
And so what's your advice for investors seeking value in an early stage company where there's little to no revenue? How do you find that number there?
As I said, there is no number. You justify, you say what you're going to raise, as long you say how much you need to raise, as long as you can justify it, and then you take that number, you divide first that by 10% because that's the minimum the angel or a seed investor will accept, and you divide that by 25 or 33% because that's the highest they might take, and the value or the answers is somewhere in the middle. And where in the middle, that really depends on the supply of potential opportunities to the investor and the demand for the founder's body of work.
Great. Well, the traditional way is a startup goes and finds an investor that wants to lead the round, have that discussion, set the valuation, put in the term sheet, and then all the other investors follow on. Is that the best way to do it, or is there a better way?
That's just the way it's always done generally. I am not, I don't know if I have thoughts around if there's a better way to do it. Investing, I do think, is a team sport. And the reason I believe it's a team sport is because you want more and more people involved because they can help you, they can guide you. Chances are, if they're investing in your company, they've invested in a company like that before, and they have seen other founders make same mistakes, so they can help you not make those mistakes.
So I always tell people the valuation is basically an exercise in articulating the value propositions in the business. And when I talk to some entrepreneurs, they say my valuation is X, and I ask, well, how do you get to that? And the answer is, well, I calculated how much I need to own at the end of this process, and so I must be worth that. And I tell them that's really not a compelling story to say that. You really need to be talking about what's in the business, what's the team, product, sales. Really articulate very clearly what's there, because that's what stands up. No matter what number you put out there, the investor is going to ask, well, how do you arrive at it? So you have to have a good reason for arriving at it. Maybe that's telling the story, but what do you think about that?
No, I totally agree. I think if a founder is saying that this is how much I need to own at the end, I mean, it's like, come on, that's I mean, okay. You should not be working with that founder. Walk away now. It's kind of like somebody going to their boss and saying, "Hey, boss, I need a raise." Oh, why do you need a raise? Because I have more expenses.
That's right.
It doesn't work like that.
Well, the early stage world is filled with first-time founders, and not everybody understands fully how it works. And I find, in these deals, the entrepreneur is looking at the deal about the opportunity. Look at the opportunity side of it, but the investor comes and they are skeptical. They're looking at the risk involved. And so one thing I think most founders don't realize is that the investors don't necessarily share the same view you have, because we're all looking at the same deal, but we're looking at different sides of that coin. And then trying to meet in the middle is the challenge there as well. How do you see that?
It becomes contentious, and that's the worst thing you can do, is to sour the relationship in the beginning. You want to work with people who you're going to be working with. So, don't do too much haggling in the beginning, because if you cash in all your chips in the haggling, and you go into a relationship sour, that's not going to be good for everybody. Listen to your investors, right? Listen to those people. They're cutting you a check. They're not going to lie to you. They're not going to. I mean, given a few bad apples, right? Those aside, right? There's always exceptions, but they're there to make sure you're successful. They want you to be successful. Ask them, right? Not everybody's a Mark Zuckerberg. We hope you are, but you're no Mark Zuckerberg just yet. Prove yourself first. So ask your investor. If they're talking to you, they're interested. They want you to be successful.
Well, that's good advice. Well, in the last few minutes that we have here, what else should we cover that we haven't?
No, at the end of the day, evaluation is all about business model. And even though venture investors are looking for that big payday, the big payday comes from companies that have recurring revenue and it requires least management to grow it. So at the end of the day, you want a business model that gives you recurring revenue, just like real estate. If you can have a business model that's around that, all investors are going to love you.
Well, great. Well, how best for listeners to get back in touch with you?
We have a YouTube channel called What's It Worth. And if you go to that channel under About, it has an email. You can email us via that.
Great. We'll put that in the show notes. I want to thank you for joining us today and hope to have you back for a follow-up soon.
Great talking to you, Hall. Thanks for having me.
Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.